Hello fellow human, nobody here with a new stock analysis. Today's question is, should you buy Disney shares? I would like to start by reminding you that liking a company and liking its stock are completely different things. That said, as always, I will jump straight into my verdict and I will give you my reasons afterward. Let's go! At today's price of $96, Disney stock is a sell. My price target for 2026 is between $90 and $130 for an average of $110 per share. This means I don't think the share price has much room to fall, but also that there is very limited upside for the coming couple of years. Disney has been mixed up with the whole culture wars thingy for a while now. Although there are plenty of people who do not complain, the company has alienated more than a few people with decisions of questionable taste. Personally, I believe they should drop the topics that cannot be integrated effortlessly into their content without compromising its quality. Also, it's better if they do not ruin too much the minds of the few children that we are having. But anyway, not here to fuel the gladiatorial games that very conveniently keep us distracted from the issues that truly matter. You're here for some no bullshit common sense about the stock, and that is what you're getting. But first, a little disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. The Walt Disney Company operates a diversified business that spans multiple industries and sectors, with one of the strongest brands in the world and a large basket of intellectual properties. The company classifies its activities into three segments: entertainment, experiences, and sports. The entertainment segment includes Disney's television networks, direct-to-consumer streaming services, and film content sales and licensing. The experiences segment comprises the theme parks, resorts, cruise lines, and consumer products, with all their immersive experiences and merchandise. And the sports segment encompasses ESPN's sports media operations, including affiliate fees, advertising, subscription fees, and other sports-related content and services. By revenue, the entertainment segment is the largest, but it has struggled with profitability with the decline of cable and the growing dominance of the very low-margin streaming business. On the other hand, the experiences segment also has huge sales, but it has much better profitability. And the sports segment is smaller by revenue, but makes a reliable contribution with very decent margins. With all that said, let's now take a look at the company's past performance. In the past 10 years, the average annual growth was 7% for revenue and minus 9.2% for earnings. I would like to admire for a second how well the company managed during COVID. Like seriously, I would expect a huge revenue loss in 2020 and 2021, which didn't happen. That said, as you can see on the chart, revenue growth has been steady but pretty slow over the past decade. And earnings were doing fine only until 2018. Slow growth doesn't usually make for a good investment, much less when the bottom line can apparently collapse at any time. And although revenue got a nice bump in 2022, thanks in part to inflated ticket price hikes, the bottom line didn't seem to care much about it. But hey, a company can and should sacrifice profitability sometimes in order to invest in areas of high long-term potential. So let's take a look at the expectations for the future. For the coming 3 years, analysts expect an average annual growth of 4.3% for revenue and a whopping 64.2% for earnings. So revenue growth will most likely be even slower than it has been in the past decade, but earnings are supposed to make a huge comeback. That's quite the wild discrepancy there. A bit odd that revenue that barely grows faster than inflation could allow for such an explosion in earnings, right? Not really. It just means the company is turning off the investment tab and focusing back on the bottom line. But despite this, the earnings per share for 2026 are expected to be around 5.7, still a long way from the peak of 8.4 of 2018. Also, to judge if this growth is sufficient, we need to take a look at the valuation. As you can see, valuation multiples are looking pretty appealing compared to their historical averages. The revenue multiple is already below its 20-year average, and the P/E ratio will get there pretty soon. Not only that, but the new surge in earnings gives us a super low PEG ratio. Not bad. The valuation multiples are looking attractive. The revenue multiple is below the long-term average, and the P/E ratio is projected to dip below 17 by 2026 thanks to the impressive earnings growth. So surely there was a trick in my verdict. I called the stock a sell, but didn't really mean it, right? Wrong. This stock is what I call a cheater. And no, it's not any nicer than the kind you find in relationships. Dumping earnings like Disney did after 2018 and quickly raising them back up sometime later has this nasty side effect of painting a fake rosy picture that can easily fool investors. Because you're now shown an earnings growth that looks incredible. But of course, it's complete bullshit. I know what you're thinking. Who cares about growth? A low P/E ratio is a low P/E ratio. 1. Get your shit together. 2. A P/E ratio between 15 and 20 is definitely not low by itself. It's often considered normal in a world with plenty of fast-growing companies, which Disney is not. Its growth barely makes up for inflation. The company is not even expected to retake its 2018 earnings peak after 8 years, even though revenue has grown by 50% since then. You might think I'm being impatient and that I should give it some more time. Sadly, Disney's estimates for 2026 tell us very little about growth beyond that point. The expected earnings growth from 2025 to 2026 is 16%. And for the stock to be a good pick, there should be little to no slowdown from there on. Which might happen, but I wouldn't bet on it. And even then, the stock would not be in a position to have top returns. So putting my money in Disney with so many better options out there would be irrational if my goal is to make money. The key issue here is that the company operates in very crowded spaces, pun intended. So it is understandably struggling. For all its brand recognition and intellectual property, Disney is having a hard time not being just one more choice among many. And I just don't see it gaining the upper hand over its competitors in the coming years. The theme parks are relatively unique and therefore have a better moat, again pun intended, but they also have limited room for growth. To sum up, the stock carries deceitful valuation multiples that are not really low considering the sad and uncertain growth of the company. You might very well like the brand and all it offers, but Disney shares make for a bad investment right now. If you found this video only mildly upsetting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.